Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And markets, while trading a little better than last Tuesday, has largely not changed a whole lot. So we want to talk a little bit about where the markets currently stand, what we're currently paying attention to, and how that reflects our outlook for the current market. Before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So as always, we will start off with the major markets just to see where they currently stand in terms of the major indices. We want to make sure that we understand not only where the major markets currently sitting, how they're kind of starting to shape up right now with the concerns that some investors are seeing from an inflationary perspective. Then we'll take a look at the sector rotation model to understand which sectors are strengthening, which sectors are weakening, so that we can position correctly within those specific sectors. We want to take a look at fixed income, how those markets have reacted, as well as commodities and Bitcoin. We're going to take a look all around in terms of commodities. There's quite a bit of weakness coming around, but there's also some strength in certain pieces of the commodities sector. And then we'll take a look at some of the economic indicators as well as our ideas here for today based on what we're seeing. So the primary question that I want to help investors answer, which is an extension of what we talked about here last week, is have equity markets shrugged off the inflationary concerns, and is it ready to resume its next uptrend here? That's the primary question that we were trying to answer last week. And again, as markets are trading a little better than last week, things have not largely changed too much. So my name is Tony Zhang. I'm the chief strategist here at Options Play, and I want to share with you my technical research, my economic research, and the vision and the views that I have for the current market. So when we look at the S&P 500, we did fill this gap that I referred to here last week, this unfilled gap to the upside. So we filled that and we've broken out here to the upside. That certainly is strengthening for the overall broader markets. There is still this downside gap that has remained unfilled. You have this gap higher here that has not been filled. I would like to have seen that gap filled before the markets continue moving higher. The fact that that has been left unfilled is concerning to me. And we do have this one last level of resistance here around 420 or 423 or so for the S&P 500 to break out higher, for it to continue moving higher. Now, we have not broken above that resistance level here, so this is still very much some resistance up here in this 420, 423 level here that we could potentially bounce off of and fill that gap. That is always the risk that I still see here for the equity markets, especially after such a strong move here to the upside. Usually we tend to see periods of consolidation or some bit of a pullback here before equity markets continue moving higher. This is the weekly chart here on the left. So the weekly chart clearly continuing to show slowing momentum, right? Higher highs in price, continue to see lower highs in momentum. This is showing us there are signs of exhaustion. This is over a longer time period. And then when we zoom in here, sorry, that was the QQQ. Excuse me. The S&P 500, very strong, but still momentum is starting to slow down here on subsequent moves higher. So this is concerning to us in the bigger picture. And, short run, where the fact that we haven't gotten above some major resistance levels, you have the same thing here for QQQ. You have the 340, 343.5 resistance level that continues to be upside resistance that it's trading into. We could see a rejection at these levels, but the fact that the markets this week managed to get back above this resistance level is short-term, somewhat bullish, if you will. But these are still long-term resistance levels that we have to contend with. And again, the one thing I wanted to show you is that continued moves higher here in price continue to see lower momentum. So think of RSI or momentum as the accelerator pedal. As a car is driving up the hill, is that acceleration continuing or is it decelerating? And that's what we're seeing here from RSI, is that a deceleration of this momentum here to the upside. Now, the deceleration itself doesn't necessarily mean we're going to see a pullback. It very well could just be a consolidation range where the markets have to consolidate for a period of time, especially after a big move. We tend to see consolidation before it can continue moving higher here. And that's largely what we're seeing here from QQQ. We've largely have been consolidating since December, since December to the February highs. We have been range bound, and that's exactly where we remain here at the moment. Until we manage to break out convincingly to the upside on some strong volume, we are still in this range bound market. Look at the Russell 2000, very much range bound. That's exactly what we're seeing here. After a big move to the upside, range bound. Right now, we're stuck right in the middle of that range. My expectation here for Russell 2000 is to largely remain in this range, and we're going to wait for a breakout either higher or lower. So far, we are still very neutral. And then when we look at RSP, the equal weight S&P 500 index, this is where the market breadth is starting to show some cracks, meaning as the S&P 500 is continuing to retest its all-time highs, RSP is no longer confirming those new highs, meaning the broader names within the S&P 500 is not quite keeping up with the rally that we've seen in the market cap indices. Now, this underperformance is very small, and it's over just a very short period of time, so I wouldn't read too much into it. Very well, we could see this catch up over the next couple of days, and that kind of goes away. But these are some of the things that we're starting to pay attention to. There's also quite a bit of complacency right now in the equity markets. The front month VIX is trading at around 18.5. The 3-month VIX is trading above a little over 22 right now. This means that there's a pretty big gap between what traders expect volatility is going to be 3 months from today versus what volatility is 1 month out from today. So, this level of difference between the 3-month VIX and the front month VIX usually speaks to a fair amount of complacency in the short run. And those are usually bearish signals. Now, or rather, they're not necessarily bearish signals. They usually signal that markets will have a tougher time resuming its continuation higher. Whenever we have a large amount of complacency, there's always elevated risk that you get a pullback here. So when we look at these things on balance, nothing here is necessarily bearish, but there are certainly signs that, these are near market top warning signals that we typically see. When we look at emerging markets, also nowhere near all-time highs like the U.S. domestic equities are. So this certainly points to one of two things. Either domestic equities is significantly stronger than international equities, which is true, or the fact that, globally, we're having a tougher time for equity markets to continue moving higher here, and that domestic equities here in the U.S. is simply just leading the pack in terms of that. So there's just a few things that we need to pay attention to right now here in the broader markets. And if we look at value versus growth, we continue to talk about value versus growth in terms of the outperformance that value has started to show over the past few months after years and years of underperforming. It had bottomed and started to show some outperformance from value. And if we zoom in here, it broke out higher here, came back all the way to retest this support level and continue to resume higher. Now, it did pull back again here over the past couple of days. Our expectation is that so far it's holding the support level and can continue moving higher. So as we look for opportunities going forward within equities, we certainly favor value names over growth names going forward. And when we look at the sector rotation model, we also continue to see what is, something that is typically concerning to us, where we see most sectors, energy, materials, financials, industrials, healthcare, real estate, consumer staples, even utilities moving towards the lagging category. So you have 1, 2, 3, 4, 5, 6, 7, 8 sectors moving towards lagging. You have one sector, technology, that's improving and starting to move towards leading. You have consumer discretionary that's moving towards improving. And then you have communications also moving slightly towards leading. So when you have 3 sectors moving in the right direction and 8 sectors moving in the wrong direction, that's not particularly strong or healthy for a market. We saw a lot of this during the late 2019, early 2000s, early 2020, before the coronavirus sell-off, where it was just technology and discretionary leading the markets higher, and then the other 9 sectors lagging behind. If this goes on for an extended period of time, that is unhealthy, and those usually are signs that we are near a market top, or that the subsequent pullbacks tend to be very quick and very violent, similar to what we saw during the coronavirus sell-off. Perhaps not at that magnitude, because we're unlikely to see another coronavirus sell-off in the next couple of years. But this type of market price action is unhealthy, where you have 2 sectors dragging the rest of the market higher while the other 9 sectors lag behind. So we've seen this a couple of times throughout the rally from March of 2020, but usually they haven't lasted for more than just a week or 2. So if they only last for a week or 2, this is okay, but if they go on for longer periods of time, that is concerning. So we're starting to see that, but this is one we're going to pay attention to. So looking at the sectors themselves, XLK recently breaking out above the 21-day moving average after lagging behind. So far, still holding generally that uptrend here, so very well could continue on its way higher here. We did talk about this chart here, where you have a very strong channel that very well has been heading in the right direction in terms of to the top of that channel. That's our expectation. You do have some minor resistance here around 142.5, 143. That it has to contend with, but very well could continue on higher towards that top of the range. So especially as that technology sector is starting to lead, this is certainly one place to pay attention to. And then if we look at the 10-year yield, after spiking a couple of weeks ago has really started to pull back here towards that 160 basis points, which really has acted as a bit of a magnet here in the short run. And interest rates have this tendency of pulling back or mean reverting to a specific level. And so far, this 160 level very much is that mean reverting level for fixed income markets. We could see a bit of an overshoot to the downside and perhaps coming back to that 160 level. But right now, interest rates holding steady, meaning this is not necessarily bearish for growth stocks. So the fact that we're continuing to stay around this 160 basis point level and finding that equilibrium is part of what equities needs in order to potentially resume its upward trend. So taking a look at some commodities here, we do have a fairly mixed bag here when it comes to commodities. Gold continues to show some strength here. We talked about the fact that it broke above 166 basis points, $166, which was a major resistance level. That was bullish. It came back to retest this level, shot all the way up to the 200-day moving average. We're seeing if it was going to stall at that level. It did not. It continued to move higher here. And that really coincides with not only breaking out above the 200-day moving average, but breaking above this major downtrend. So this is a fairly bullish signal here for gold, and we still expect gold to continue on to this 184 level here to the upside. So gold doing very well, which is almost an inverse here of what we've seen in terms of Bitcoin. Now, to look at Bitcoin, we really have to look at a few things. We had the major breakout here above 20,000 that ran all the way up to about 42,500, pulled back to about 30,000 before running higher here. And we can call this up here a bit of a topping formation, if you will. Some of you could call this a bit of a head and shoulders topping formation. However you want to call it, that very well is a topping formation. It came all the way back to retest this $30,000 support level, which was where it pulled back to after its initial rally after the 20,000 level. It basically tagged this level and bounced higher to the 200-day moving average. So far, it's been rejected at the 200-day moving average. My expectation is that you're likely going to see a bit of a consolidation in terms of Bitcoin within these levels, and then potentially continue its rally higher after consolidating for some time. And then when we look at some other commodities like crude has stalled here around the $66, $67 resistance level, which is a long-term resistance level that we have seen since before the pandemic. This also makes some fundamental sense that OPEC, generally speaking, wants to keep oil in this particular range because it's at the price where it is profitable for most of the oil OPEC nations, but not particularly profitable for many of the American shale companies and fracking companies. So this is kind of that sweet spot for oil in terms of global oil with OPEC. So, I don't know that we're going to see much upside here from oil, but also I don't see particularly a lot of downside. I certainly think that you're likely to trade within this range around 60, 58 or so up to the 66 level based on short-term fluctuations of oil. So, for energy shares, this certainly starts to put a bit of a cap here for XLE, as we've seen XLE come down on relative strength quite a bit here as well. And then when we look at copper, copper, lumber, any of these, industrial commodities, we've seen big moves here to the upside. We've pulled back here, similar to recent pullbacks. The question is whether copper can continue moving lower here. So notice how prior pullbacks, the 21-day moving average largely has held as support, but this one, the 21-day moving average is broken, and it's came back to retest that 21-day moving average as resistance, and the question is whether this gets rejected. So far, it's, the early data certainly seems to show that is being rejected here at that level. This is going to put a cap here on some of the mining stocks, whether we're talking about Freeport-McMoRan, Newmont Mining on the gold side. Those are some of the names that you want to understand as to what are they mining and what's their exposure if you're looking at mining stocks. And then when we shift over here to the economic side of things, this is again where inflation surprises is really the issue for a lot of equity investors here right now in terms of inflationary surprise numbers, CPI numbers, manufacturing cost numbers, wage inflation numbers. These are all surprising here to the upside, substantially higher than what we have ever seen here over the past 10, 20 years or so. So we're at all-time highs. The question really, for the most part, is this inflationary concern somewhat temporary, or is this something that's going to be longer lasting? That's the debate that a lot of investors seem to have. So far, the consensus is that this is going to be somewhat transitory. As you can see, the difference between expectations in short-term inflation over 2020 versus inflationary concerns over 2022 is relatively divergent. Meaning we're not necessarily expecting this, at least for now, the economic forecast for inflation is divergent between this year and next year. So everything with issues with the supply chain that's causing short-term goods to be extremely costly. Everything from China buying up a ton of the available raw material goods for a rebound in the economy, causing some short-term inflationary to raw material prices, to wage inflation due to stimulus and people getting back to work. This is the question is really, are those issues going to resolve themselves within this year and normalize again by next year? So far, economist forecast seems to believe that it is transitory. This is Bank of America's forecast in terms of CPI. Their expectation here was that April was going to be the highest, and then by May and June, we're going to start to see that normalize and come back down again. So this is certainly relatively positive here for the views here. Now the question is, in the next few months, we'll really get to answer that question. And if we do see CPI continue to be beyond elevated than we were expecting, that's going to be a concern, I think, for a lot of equity investors. So this is one that you really have to pay attention to as equity investors. So taking a look at the ideas here for today. This is really where, for a while, we haven't taken a look at airlines for a while, because airlines, after having a pretty strong run here in the beginning of the year towards the middle of March, have largely underperformed the broader markets for the past 2 months. Now, they are starting to come back to life again here. And most airlines, if you look at the price action for most airlines, they look very, very similar. So you can really use quite a few different proxies for this. However, we do see some differences in terms of bookings. We do see some differences in terms of path to profitability. And certainly there's very huge differences between different airlines and the amount of debt they're carrying. So really from our perspective, we certainly prefer the more domestic focused airlines that have lower amounts of debt. This encompasses JetBlue, Hawaiian Airlines, Southwest Airlines, Alaska Airlines. These are the names that have largely come back to normal, if you will, in terms of travel. They don't have a lot of exposure to business travel, even though we are starting to see signs that business travel is picking up. But the lower debt carriers that are focused more domestically on leisure carriers are likely going to rebound faster and get back to profitability faster and not have a huge debt loads to support, so any of those names really are suitable. The reason I'm actually looking at Hawaiian Airlines is because out of all of the options markets, the Hawaiian Airlines is actually reasonably liquid. Most of these smaller regional domestic airlines are not particularly liquid when it comes to options, but Hawaiian Airlines was reasonably liquid, which is why I chose to use this particular airline. Pulling back to this $24 support level after consolidating for quite some time, recently breaking out above the 21-day moving average. That is a signal from a timing perspective that Hawaiian Airlines is potentially continuing to move higher towards that $28, $29, $30 resistance level and potentially breaking out above the 200-week moving average and continuing onto a much longer path higher here. So timing-wise, I think airlines, having pulled back here for the past couple of months, consolidating, it's time to revisit this, especially as things reopen and booking data looks fairly strong. On the flip side, as we reopen, you have some big names during the pandemic that really took advantage of our lockdown and took advantage of the fact that people were staying in and doing and finding alternative work. Etsy really is the crown of that. Largely completing this topping formation here and recently breaking below the neckline, and so far being rejected at both the 21 and the 200-day moving average. So this leads me to believe that Etsy is likely seeing further downside going forward. Money flow looks fairly weak. Momentum looks weak both on the weekly and daily charts here. So rejection here at the 200-day moving average unfortunately looks quite terrible for a name like Etsy. And then when we look at that technology sector, I was showing you technology as that silent stealth rotation into technology. I think a lot of investors are tempted to get back into some of those higher beta tech names that have performed very well last year, performed very well early this year, hoping to perhaps make back some losses that you may have sustained in some of those names over the past couple of months. But I encourage investors to largely stay away from those higher beta tech growth names because even at 160 basis points, those names do not look as strong. They do not look as attractive from a valuation perspective. So those are the concerns that I have. So in technology, I much prefer to be in the more boring stocks that are profitable, that have a large market share of the businesses that they're in and, are not growing at the crazy multiples or trading at the crazy multiples that the higher beta tech names here. So what I like here is Facebook. Facebook, after consolidating for quite some time between this 250 and 300 level here or so, it's been in this since August of last year, recently breaking out above this level, coming back actually multiple times to retest this support level, but so far holding that. And that is confirmation that we've established a base up here and it can continue to move higher going forward. So when you're looking at technology names, I much prefer being more boring at this time rather than being more speculative, looking at those higher beta tech names and hoping to find the one that is going to take off again, because the chances of that here in this higher inflationary environment is less likely than a name like Microsoft, Facebook, Apple continuing to dominate in their particular space, which again are largely profitable and can return that profitability to investors through dividends, through share buybacks, unlike the higher beta tech names that cannot do any of that, that are largely, especially the ones that are not profitable. So with that covers what I wanted to share with you here today, and I hope that this helps you, give you a better understanding as to how we're looking at this market. And just a little bit of housekeeping. I am off next week, so the next week's Tuesday morning Outlook session will not occur, but I will be back here 2 weeks from today to resume our Tuesday morning market Outlook session. So with that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here in 2 weeks' time. Have a great trading day.